The tariffs are not on the rest of the world. The tariffs are on Americans. That's who pays the tariffs. Well, we don't have the how are we going to do it? We're too busy wasting our time on cryptocurrencies, and all kind. Where are we going to get the resources? And we're funding. We have to fund our massive government debt. I mean, gold is above 3,100. We're right near record highs. We set that record high last night, but gold's going up.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the EdJR mining guy over on X, and of course, your host of this channel. And I'm looking forward to welcoming back Peter Schiff here in a few short seconds. He's the global strategist, chief economist over at Euro Pacific Asset Management, and we couldn't have timed it any better. Really, really important day in the market. Some would say it's historic. We're seeing the S&P 500 correct by over 4.5%. The Russell is now in bear market territory. It's down over 20% on the year. When we have to discuss what's triggered that, of course. And if you're not living under a rock, you might have noticed that the U.S. announced blanket tariffs on pretty much the world. 185 trading partners are getting tariffed now. We'll have to discuss what that means. Why are they doing this? Is it more than just a tool? What happened? And of course, we'll talk with Peter about gold. The gold price move today, really, really interesting intraday, and we'll get to the bottom of this and where does Peter see it going, of course. And I'll also ask him whether he's doing his Schadenfreude dance in regard to Bitcoin a little bit, because gold is going up, Bitcoin is trending down. I'm curious if he's practicing his dance moves already here. So before I switch over to my guest, hit that like and subscribe button, of course. It helps us out tremendously, and it doesn't cost you a thing. So thank you so much. Now, Peter, it's great to have you on the program. Thank you so much for joining us again.
Oh, sure, Kai. Thanks for inviting me back on.
Yeah, really appreciate it. I have to admit, I half expected you not flake out, but do something else today. It's a really busy and historic day in the markets, I would say, and maybe you can frame that a little bit for us. What does it mean for you today and the market action in general?
Well, I mean, we're having a great day as far as performance. It's not that we're falling less; we're actually up. We're actually having a big up day today, even as the Dow is down 1,500 points. The Russell 2000 is down 6%. But many of the stocks in my portfolio in US dollars are up 3, 4, 5% or more today. And that doesn't even count the gold stocks that were way down this morning. Some of those stocks were down 4 or 5%. Now they're up 2 or 3% now. And they're going a lot higher. I think the gold stocks are very cheap. But what we're really seeing is a major rotation out of U.S. markets into foreign markets and out of growth-oriented companies into value dividend-paying type stocks, because that's what I own, and that's what's going up so much. And also, a lot of the companies I own focus on consumers outside the U.S., and that is the market, because Americans are not going to be able to afford to buy as much stuff because of the tariffs. And so businesses all around the world that were selling goods to Americans are going to sell less goods to Americans because the prices are going to be much higher. And now they're going to be selling those goods into other markets. So there's a lot of opportunity now outside the United States. There's a lot of pain that we're going to be going through in the United States.
It was phrased as Liberation Day, but I feel it a little bit as like Economic Handcuff Day to a degree. Well, of course, short-term pain, right?
It is a Liberation Day. Trump just doesn't understand who's being liberated. It's the rest of the world that's being liberated from the burden of subsidizing the American economy. Americans are liberated from all the cheap goods that we used to get. And the low interest rates and the bull market in assets. It's a mistake to think that the world is ripping us off because we get to consume what they produce. We're ripping them off by not paying for it. We give them, or they give us real goods, and we just give them pieces of paper. So they're the ones that have been getting ripped off. But yes, Trump is right that this has been reducing our net wealth because we've been selling off our cows to buy milk because foreigners are buying our stocks and our real estate with the money they earn selling us stuff. But the short-term trade-off is that we have a higher standard of living. And that's what's about to be lost. And that's what the president doesn't understand when he promises an immediate economic boom. The transition that he wants is going to be very painful. And it's going to take years and years before there's light at the end of the tunnel. In the meantime, stocks have to go down, real estate, bonds have to go down, interest rates have to go up, actually. The economy has to go through a serious recession that will probably span the entirety of his presidency. The problem is that Trump hasn't prepared the country for that. Trump has promised something he can't deliver, which is an immediate boom.
Yeah, where is that boom supposed to come from? I don't see the growth areas here. Of course, he's trying to strengthen the American consumer, but that's not really happening by taking away the cheap goods or slapping tariffs on those goods.
No, he's focusing on the jobs he thinks we're going to get in the factories. Well, we're not going to make that many factories, so there's not going to be many jobs. But most people aren't factory workers. They're going to lose jobs. And even if they don't lose their jobs, their paychecks are going to go not go as far, because everything they want to buy is going to be much more expensive.
Yeah,
and the tariffs are not on the rest of the world. The tariffs are on Americans. That's who pays the tariffs. The Chinese don't pay our tariffs. The Europeans don't pay our tariffs. The Mexicans, the Canadians don't pay them. Americans pay them.
Yeah, they'll be added to the goods that are being sold into the U.S., of course. But, the question is, like, for me, and I briefly mentioned it to you before hitting the record button, that he used tariffs before to sort of leverage his way into getting what he wanted, either like stronger border protection and other things. What does this blanket tariff mean? Like, what is he trying to achieve here? Help us understand it a little bit, Peter.
Well, he's just been misinformed by his people that he has surrounded himself with, who are economic ignoramuses, who don't understand, the consequences of what they've proposed and what they've convinced Trump to do. Although Trump, if you look back historically, I mean, Trump has always talked about, other countries ripping us off. So he's kind of predisposed to believe some of the nonsense that some of his advisors are blown in his ear. But he's hoping to, reinvigorate our once great manufacturing base. And I would share that goal. But tariffs aren't going to do it. You have to understand why we lost all those factories in the first place. And putting on tariffs isn't going to bring them back. But what we need to do to bring them back, they're not doing. I mean, we need massive cuts to government spending. We need a lot more deregulation. We need higher interest rates. We need to reform the entitlements. We need to cut Social Security, Medicare. We need to cut defense. We're not doing any of the things that we need to do. And we need massive deregulation in the labor markets. The unions. I mean, there are a lot of reasons that we're not manufacturing in this country. And you can't just put a Band-Aid on it with a tariff and assume that everything is going to heal.
Yeah, it's not a one-way street either, right? Europe already has been sharing lists of reciprocal tariffs, and there's just a tariff war breaking out. And I hate using that word, really, but it's not a one-way street. The
tariffs aren't even reciprocal. He's just calling him reciprocal so he can use that power that Congress gave him. I think it's all illegal because it's not reciprocity. Trump is putting tariffs on nations that don't even have tariffs. And the tariffs that he's imposing are way out of proportion to the tariffs other countries have. Because where he's getting these ridiculous numbers is he's come up with some, BS formula that basically claims that any nation's surplus with us is the result of tariffs, even if they don't have tariffs, or even if the tariffs are so low that it barely makes a difference. So when he says, oh, Europe has 38% tariffs, so we're going to put 20% tariffs on. Europe is maybe 4% tariffs. So what we're doing is not reciprocal. It's pure protectionism. I think it's illegal, but he's doing it anyway. But that's his goal. The goal is not to raise revenue. The tariffs are too high. The goal is protection, but I don't think they're going to work. I think they will raise some revenue, a lot less than they expect. I think that's because Americans are going to pay these tariffs. But a lot of Americans aren't going to pay the tariffs because they're not going to buy the goods.
Yeah, like especially if they're not being offered anymore. Mercedes, just as an example, announced that they might not be selling their smaller vehicles in the U.S. anymore because it doesn't make sense, for example. So
they're not going to sell the low end because they know the consumer on the low end won't be able to afford, the extra 20%. But on the high end, yeah, they'll just jack up the prices 20%, and the rich people will just pay 20% more for the higher end Mercedes.
Yeah, they don't care in that regard. As we
I mean, they care, but they still want the car. But they will sell fewer. I mean, I think what will happen is people will drive their used Mercedes a little bit longer before they buy a new one because of the higher prices. But of course, what's going to happen to the used car prices, if you've got one of these low-end Mercedes Benzes that they don't bring in anymore, your used car is going to go up because people are going to have to buy them used because they won't be subject to tariffs if they're already here.
Yeah, it's a very interesting discussion I've had with Stagflation as well on our channel before. And the average age of a car on the US roads is 12.8 years right now, and it's the highest it's been since I think 2008, 2009. So it's been trending up.
Yeah, so this is good news if you can repair cars. Problem is, though, the parts are going to get more expensive because they're all imported.
Yeah. O'Reilly Auto Parts. We should go long, I guess. But but stagflation is a term you've been using a lot, and I can see it written in all caps now because economic growth is definitely going to be muted, for lack of a better term, while inflation, as you mentioned, and we'll probably be seeing here in the next few quarters, will be trending a lot higher.
I made fun of Jerome Powell almost a year ago when somebody asked him about stagflation, and he kind of laughed it off, and he said, "I don't see the stag, I don't see the inflation." And I said, well, he's obviously blind. And my prediction was that comment about no signs of stagflation would go down in history with subprime is contained and inflation is transitory, because he was completely wrong. Not only is this stagflation, but it's recession, severe recession, and high inflation. It's going to be far worse than anything we had in the 1970s. When people say, oh, this stagflation, oh, it's not like the 70s, they're right. It's way worse than the 70s.
Let's see if we can take emotion a little bit out of it. We're all reacting to this, to the news emotionally. The markets are reacting as well. What I'm trying to understand is when those tariffs will actually hit the consumer. Like, I'm trying to understand that lag effect. When do we see those numbers, and inflationary numbers, also hit the market? What's your expectation on that, Peter?
Well, the tariffs hit right away, right? But the tariffs aren't paid until the goods are imported. And if you noticed, our trade deficits in the U.S. for the past few months have been off the charts. And so what I think is that a lot of companies saw the tariffs coming and they ordered some inventory. So they have to work that inventory off first. So those products can be sold without the tariffs. Now, I think they will raise prices somewhat because they realize that this is their last chance to make money. Because once they run out of those goods, they have to pay the tariff on the new goods, and their customers probably will be priced out of the market, a lot of them. So you'll start to see some initial increases in prices, but it won't fully hit until they run out of stuff. And, there's going to be a mad dash. I mean, some people are going to rush to the stores and, they're going to buy new sneakers, for example. Maybe they'll buy 3 or 4 pairs, knowing that, they're going to wear out. They'll want to get another pair. They're going to wear out because all those sneakers are going to get so much more expensive. So some of these companies, could see a rush of sales, now until they use up what they got. And then their business is going to dry up, substantially.
Yeah, and that's what I'm exactly trying to figure out, sort of that timeline as well, that lag effect that we'll be seeing that's coming through here. And, as you said, like shifting financial assets to consumer goods, and it's a ticking time bomb to a degree that'll just implode the economy. Is that 3 months away? Is that 6 months away? Because, timing it is probably impossible, right, Peter?
Yeah. I mean, well, I don't know exactly, but we're going to be reversing a process that, has on the surface been benevolent, but it really wasn't if you understood it. But now it's going to be very sinister. See, what's been happening is we create inflation, printing money. We export it to the rest of the world, and they ship us the stuff that they make. So we have goods to buy, and the money goes abroad. And so that keeps prices down, and we get more stuff. Then the foreigners take the dollars they earn and buy our bonds, buy our stocks. That gives us lower interest rates and a higher stock market. So we get wealthier on paper, we get to borrow cheap, and we get all kinds of consumer goods we didn't produce, and they're low cost, right? What's going to happen now is all that inflation is now going to move from Wall Street back to Main Street. We're not going to have as big trade deficits anymore. So we're not going to be able to export as much of our inflation. It's going to stay here. We're going to have more money chasing fewer goods. So a big increase in prices. Foreigners are not going to buy as much U.S. stocks and bonds. So we get a lower stock market and higher interest rates. So that's the reverse of what we've been enjoying, right? And so it's going to be the worst, thing for Americans because they're going to be getting poorer financially as their cost of living is skyrocketing. And many Americans are going to lose their jobs. So we're going to go through the worst economy in modern memory. Now, I don't think anybody alive today has seen an economy that's going to be as bad as this one. Now, it may get better eventually. Maybe we get the benefits of AI and stuff like that. But in the short run, things are going to get very, very bad. And that's horrible for the Republicans because, Trump just blew them up. I mean, the Democrats were in disarray. The party was really in shambles, and this is going to galvanize them because Trump is going to be the villain that did this. They're going to be able to say he inherited a great economy, which he didn't, but then he destroyed it. And the Republicans are going to be out of Congress in the midterms. I mean, the Democrats are going to get the House and the Senate.
It reminds me of a quote from the Batman. You have to be the hero long enough to see yourself become the villain. So to a degree, I think that fits quite well. He was, hailed as the savior of the U.S. economy. Now he's becoming the villain. Am I misinterpreting the role here? It's like, are we painting the hero as a villain here? It's like, is there more to it? Can he actually save it and turn it around? He's only got 4 years to do it. So
it's not going to happen. It's not going to happen because first of all, he needed to level with the public about how bad it's going to be. He promised a boom, an immediate economic boom, and he's not going to deliver that. So he's not going to have any credibility with the public. Neither are the Republicans who rallied around him. And I think that they're going to give up because we're going to be, in a severe recession. We're going to be maybe in another financial crisis, and they're going to be going back to government stimulus. They're going to be going back to QE and stimulus checks, and all that's going to do is, throw gasoline on the inflation fire.
Yeah, I was going to say, it's like that in that regard, because the debt problem is not being tackled here. This is like a sideshow to the main event, and with the trust eroding, the U.S. dollar dropping, and looming refinancing needs in the U.S. of $7 trillion this year. What has that done to the likelihood of being able to refinance here and the confidence in the U.S. economy? Who would give them money?
We're not going to be able to find. After vilifying the rest of the world and imposing all these tariffs, now we're asking them to keep buying our bonds. They're not going to buy our bonds. So who's going to buy them? And here's the problem. The president wants us to reindustrialize the country and build factories. Well, if we're spending our money building factories, how do we have money to buy government bonds? And if we end up having to buy all these government bonds, there's no money to build factories. It's all crowded out. So nobody is connecting these obvious dots. We can't do what the president wants us to do. We need to do it, but it's not possible unless we have a massive collapse first. We actually have to cut Social Security and Medicare and defense. We may even have to default on our debt in order to free up the resources to build these factories.
Yeah, it's like it might take a few days to let the dust settle a little bit to really understand the game plan behind all of this, because it seems very, very deliberate what is happening here, and taking into account that this might crash the economy. April 2nd might be the day that's being remembered as the start of the Great U.S. Recession, or even depression, if we want to go that far. How much emotion are we? Like, when we talk next week, Peter? Do you think your views are going to change at all?
Why would they change? I haven't changed in decades.
No, I know. It's like it's like trying to rationalize the announcement a little bit. Like maybe we can see a bigger picture, or maybe even a strategy behind it. And that's what I'm trying to understand.
Oh, is Trump? I don't know. I mean, obviously he's not going to like the stock market reaction. So who knows how they'll try to get out of jail here and save face. I don't know, but if he backtracks, remember he announced these tariffs with such fanfare. I mean, he even proclaimed like a national holiday. So Liberation Day. How's he going to now turn that around and say it was an April Fool's joke? But so he's kind of wedded to this.
Yeah, and it was maybe one saving grace is he's trying to throw American companies a bone by announcing that he might support investment in the U.S. Sounds like there's going to be grants or at least cheap debt available, maybe.
But why would foreign countries want to come and build factories here? It doesn't make any sense, and we're not going to build factories here either.
Yeah, you can't, because the demand won't be there. Like, if you look at the demand moving forward, how can you rationalize that, right?
Well, we don't have we don't have the how are we going to do it? We're too busy wasting our time on cryptocurrencies, and all kind. Where are we going to get the resources? And we're funding. We have to fund our massive government debt.
Yeah, the debt ceiling still hasn't been lifted yet either. That's another topic we can briefly talk about, Peter. How that fits in the whole discussion, because that'll implode at some point as well.
Yeah, Donald Trump is leading the charge to raise the debt ceiling. He should be leading the charge to leave it in place and force the government to cut spending. Instead, he wants to make it easier for the government to keep spending.
Absolutely. No, let's change tax here a little bit. Let's talk about how the market reacted to all of this. Of course, S&P 500 down 4.5%. You mentioned the Russell down 6%. I'm really keen to talk about gold with you, Peter, because we need to talk about the function of gold and just the trading behavior in the last 24 hours. We've ran from all-time high, crashed 130 points. We made up 70 points roughly. Is gold fulfilling its job? Is it doing its duty?
Yeah, I mean, gold is above 3,100. We're right near record highs. We set that record high last night, but gold's going up. It's going to keep going up. This is de-dollarization. It's just the central banks that have been driving it up. We haven't even gotten the real investor demand yet. That's coming. Retail investors in the U.S. are going to be buying gold, but they're going to be buying it at much higher prices. They're going to be buying silver too at much higher prices. This is a de-dollarization. The dollar is going to go down. I mean, today the dollar is down by over 2% against other fiat currencies. It's one of the biggest moves down in one day in the dollar that I can remember. One of the biggest ever. And this is just the beginning. So many people were predicting that the tariffs would cause the dollar to go up. And they thought that would take the sting out of the tariffs because, yes, we'd have to pay the tariffs, but we'd get to buy the foreign goods cheaper with our higher dollar. Well, instead, the dollar is falling, and that's going to augment the damage done by the tariffs. So not only are Americans going to have to pay tariffs on what they import, but what we import is going to cost us more because of the weak dollar. So, it's a double whammy.
Absolutely. I drafted some questions about two and a half hours ago, Peter, and I had to completely rewrite them. But one of the questions I was going to ask you is why are bond yields dropping and gold dropping at the same time? Should gold be going up and bond yields going down at the same time? But that's changed, of course, within the last 2 hours.
Well, gold is just noise. It's just a bunch of trading going on today, the shakeout. Bonds are rising today, but I think that's temporary. I think bonds are going to fall because inflation is going to erode away their value, and a reduction of demand due to a weak dollar is going to lead to lower bond prices. And of course, as the U.S. economy goes deeper into recession and we get larger budget deficits, that increases the supply of bonds to sell, and we have fewer demand for those bonds. Meanwhile, what no one's talking about is over the next 4 years, about 26 trillion of the 36 trillion national debt matures. So all that debt has to be rolled over. Who's going to buy that? So bonds are going down. The only thing that's going to stop that is the Fed going back to QE. But even that'll be temporary because that will create even more inflation, which is the worst thing for bonds.
You mentioned we need higher interest rates, but what you say, QE, the Fed coming in and the bonds going down, doesn't that mean the Fed will have to cut?
They don't have to cut, but they will cut. And that's why it's counterproductive. Look, we need more factories. We need to build the infrastructure, the supply chains. Where does the resources come from to make those capital investments? It has to come from savings. Well, what's going to encourage more savings? Higher interest rates. So unless we get the higher interest rates, we're not going to get the savings. And without the savings, we're not going to make the capital investments to reindustrialize. So anything that they do to keep rates down which discourages the very savings that we need to do what Trump claims he wants us to do, is all counterproductive. And it just makes the problem worse.
And we can agree, Americans never been big savers anyway. But having this
No,
discussion with you,
we were until the Fed destroyed that with its cheap money policies.
yeah, I think the U.S. savings rate is 3% or so. What the
probably
consumer
less than that.
saves?
We lied
Yeah. No, what is interesting, like I keep coming back to Japan in all our conversations here, and it seems like we're at this Japan moment where we're headed that direction with cheap debt. We have to buy our own bonds and finance the own economy. Is that the way we're headed now? The U.S. dollar is leading the charge here?
Well, I think the dollar has been the source of our artificial economy. We've been able to live beyond our means because we can export dollars to pay for goods. I think that's the process that's going to be reversed. And Trump accelerated it with the tariffs.
No, absolutely. The question is now, are we going to go to 250% debt? And it seems like you used the word de-dollarization earlier. Is the U.S. dollar on its way to lose world reserve currency status? I think that's where this
I think it is. I mean, I think there's no question about it. That's what gold's telling you. I mean, what are central banks doing when they're buying gold at $3,000 and not buying treasuries? They're saying that we'd rather own this metal than get 4.5% yield on U.S. Treasury. So they don't trust the treasuries because they don't trust the dollars. So they want to own gold. And this is a process that is still early and has a long way to go to play out.
Yeah, it's like I'm trying to make sense of it all because ideally, like term risk should be priced in. I haven't looked at the 30-year, for example, because why would you believe that it's going to get paid back ever? It's an interesting move because today it's a flight to safety, and I always thought the U.S. dollar was a safety haven as well.
You can't price in risk that you don't perceive. That is the problem. The markets don't see how much risk there is. That's just like, remember with the subprime market, which I was short for, the subprime market, they were pricing these bonds above par when in my mind they were worth zero. Now, why was the market pricing them? Because they didn't perceive the risks that actually existed. And the same thing is happening in the treasury market. There's a lot of risk out there that investors just don't perceive. And so if you don't know the risk is there, you can't price it into your models. But once people start to recognize this risk, it will be priced in. That's why bond prices are going to crash. Just like
No, it makes sense. And I follow that logic, obviously. Peter, I want to be respectful of your vocal cords here a little bit and your voice. Last question, just commodities. You touched on silver and copper as well. Where do you see the prices headed right now?
Well, much higher. They're down today because a lot of people are also talking about a global recession because of these tariffs. And I think there's going to be a big recession in the U.S., but I don't think it's going to be global because none of the world's factories are going to disappear. They're all still going to be there. And they're still going to sell stuff to America, just not as much as they did. So what does that mean? That means they have extra stuff to sell to consumers in other countries. And as those currencies are rising relative to the dollar, those consumers are richer anyway, and they can afford the products. So I think the world is not going to have a recession because of this. I think it may even have a boom because, what they have to do is very simple. They just have to find new consumers for what they're already producing. And there's billions of people around the world that are happy to consume. Anybody can consume. But what America has to do is build factories out of nothing. So, because we can't consume if we don't produce. And so starting to produce what we haven't produced is much harder than consuming what you already produce. So we're the ones that have the rough road ahead. We're going to be enduring the recession. So I think selling commodities based on fears of a global recession are wrong. The U.S. is going to have a recession, but our loss is going to be the world's gain. And so I think demand is going to be very robust for commodities around the world. Even if it's diminished here in the U.S., it's going to be a lot higher outside.
Yeah, I think we're moving more and more towards an even more multipolar world here. One thought that just came up, you mentioned that I actually expect deflationary pressures, especially in the Western nations, like in the European nations, for example, because we're not well off here. Don't get me wrong.
Yeah.
Like, we're not well
But
off.
in the meantime, this is a major decoupling. People should really look at my investment strategies. I mean, we could have the only mutual funds that are going to be up today on the long side. Maybe there's my funds are positive on the day. Our managed accounts are positive on the day. Being 100% long, because we're long the right assets. And these are assets that I think are going to be going up for years and years to come as the air comes out of the US bubble and as inflation moves from financial assets to goods, from Wall Street to Main Street. It's also going to be moving from the US to abroad. And emerging markets in particular have a lot to gain. We own these stocks. The gold stocks, people could go and buy my funds. My gold fund, the symbol you can get it, no load, EPGIX, at any discount broker. But we have separately managed accounts as well, where we have all these investment strategies. You can learn about them at Euro Pacific Asset Management, Europac.com. The U.S. stock market, even though it's down big today, even though the Russell 2000 is now down 2%, 22% rather, officially in a bear market, the NASDAQ and the S&P will soon follow the Russell into bear markets. The markets are still very high compared to where they've been in the past. So getting out now is still getting out near the top. It's not the very top, but it's close enough. So it's not panicking to recognize a change in trend and to reposition your portfolio for the new trend.
Fantastic. Peter, what a wonderful conversation. A little shorter than usual, but really appreciate your time jumping on this really
I've had
day,
this
actually.
problem with my voice. Yeah.
No worries at all, Peter. I always appreciate you making the time. Thank you so much. You just mentioned the website as well, Europac.com. So everybody can go check it out. We'll put the links down in the description below as well.
All right,
so
thanks,
thank you so much. Thank you so much, Peter, and everybody else. Thank you so much for tuning in. How are you playing this, tariff war, the onslaught, economic war declaration, things like that are being thrown around, or terms like that are being thrown around the financial media today, and the markets are bleeding. It is interesting out there. How are you positioned? Put it down in the comments below, leave a like, and of course, subscribe to our channel. We tremendously appreciate it. Thank you so much for tuning in. We'll be back with lots more here on Soar Financially. Take care.